6 years ago, a world that teetered on the edge of the worst economic plunge since the Great Depression was arguably rescued by a wave of massive and unprecedentedly coordinated public stimulus measures. Among other things, central bankers of the world opened the floodgates to a surge of liquidity that would help carry a panicking global economy to the shores of relative safety. One unintended side effect of QE saw investment cash flood out of safe assets and into a number of riskier ones. This never-ending search for yield helped bid up the price of emerging market sovereign and commercial debt. Currency forecasters were forced to abandon their traditional models, or at least substantially up their speculation components in the face of a reinvigorated carry trade. Global equity markets began their ascent to new peaks. And copper's 123% surge in 2009, viewed against a completely stagnant global economy, prompted calls to strip the red metal of its honorary doctorate in economics, so bestowed for its past ability to predict global growth cycles. But if, as the saying goes, a rising tide raises all boats, then, as Warren Buffett likes to remind us, it's only when the tide goes out that we see who is swimming without shorts. The eventual net reduction in aggregate global liquidity means that there will, at some point, be less money available for everyone. And while there will be winners and losers, some will lose more than others. In emerging markets, while capital inflows tumbled almost 20% last year, and another stressful year is expected this year, some did take advantage of the high tides to boost competitiveness, make labor markets more flexible, and improve the efficiency of public institutions, a divergence highlighted by the effects of the so-called taper tantrum. So the real impact on emerging markets will be the return of risk differentiation within the emerging market class itself. While this is a normal process that markets have to endure every few years, the real concern is more around the absurd extreme of that lack of risk differentiation. Because QE didn't simply encourage investors to explore traditional corporate and sovereign risk. Given the flood of money chasing somewhat limited assets, securing a decent return meant venturing further and further along that risk continuum. This prompted investors to embrace a host of high-risk assets at increasingly declining returns that may not be adequately compensating them for the risks assumed. The consequences of these ultra-loose monetary policy distortions? Well, at one point, investors were offered less than 250 basis points for assuming Gabon sovereign risk over and against U.S. Treasury risk. U.S. junk bond issuances soared since 2009, and prices for high-yield corporate debt tested historical peaks. Last year, we had more than $20 billion go into subprime auto asset-backed securities, subprime ABS. And once we ran out of places to stash our cash, we began betting on the weather. Investors snapped up $8.1 billion of catastrophe bonds last year, most of which went to pension funds and other large institutional investors. Even in Germany, a country not typically known for bubbly behavior, demand for investment properties has heated up, pushing the price of new builds up more than 25% since July of 2009. However, in a world of negative interest rates, such probability-weighted expected loss may be a reasonable alternative to the certainty of costs charged on deposits. But what happens when some of these recent entrants into the sovereign bond market struggle to service foreign currency debt as local currencies depreciate? Could pension funds be in for a surprise the next time a major hurricane strikes a small island economy? The bottom line? Perhaps the threat of the imminent economic plunge was so catastrophic back in 2009 that officials were forced to focus on that. But if, as some say, 2008 and 2009 was a function of the recession we didn't have in 2000 and 2001, then what would the bursting of some of these bubbles look like over the medium term? The cash we pumped into the system this time around makes Greenspan look like a hawk. One can only hope that national regulators have learned more from the last 7 years than markets have. Until next time, I'm Stuart Bergman.